Hello, Marc from ADM Investor Services International. So my first chart this week is the US dollar index, and as one can see, we are plummeting towards the big levels that we last saw back at the beginning of 2018. To a certain extent, this is predicated on views that the global economy is going to be recovering, and therefore we will see a decent pickup in global trade, and a pickup in global trade means that there's basically going to be a lot more excess trade dollars around, and those excess trade dollars are going to be recovered. Basically rather reapportioned in terms of portfolios, and therefore creating demands for other currencies. That's all well and good. But for some of these moves in the dollar, obviously the thing that people focus on most is euro dollar. And that's the next chart. And as one can see, we are again back at those sort of levels, very much in a similar sort of vein to the dollar index that we saw back in 2018, threatening a test of 125. But at the same time, one has to say that if one were weighing up who is going to be doing more in terms of central bank policy easing, the Fed may be looking at tweaking some of its portfolio to do a twist trade to extend the maturity of its portfolio, but it's unlikely to be actually doing considerably more QE, let alone cutting interest rates. By comparison, the ECB certainly is looking to extend its portfolio, add perhaps cut some rates on some of its programs, and indeed extend the maturity or the timeline for its QE. Therefore, on balance, that's a more euro negative factor. Typically, obviously, this dollar euro is quite responsive to the 10-year US Bund spread, and that's my third chart today. And as one can see, as much as it tightened up considerably post the March debacle, we are starting to widening out again, i.e. a move which is basically in favor of US rates and against euro area rates. And the widening makes good sense given what I've just said about prospective moves by the central banks. So that doesn't really explain it all, and maybe also raises some questions, particularly given the prospects for the US economy still look rather better than for the Eurozone economy, particularly given the problems that they're having implementing the Eurozone recovery program. But far more significant in terms of actual movement is my fourth chart, which is the US dollar versus the Asian currencies index. And as one can see, that's been in very sharp decline for a very protracted period, which makes actually complete and utter sense given the strength of the Asian economies, both pre-pandemic and indeed as we try to recover from it, they have held up much better. So that makes good sense. Right, the fourth chart today is to highlight just how much this weakness in the dollar is helping commodity prices. And this compares the US dollar index, which is the white line on the chart, against the Goldman Sachs commodity price index. And as one can see, this has rallied very, very sharply. This makes a lot of good sense in the context of that excess trade, those excess trade dollars being recycled into other currencies. But my sixth and final chart is one where I would actually raise some questions. Namely, that is the oil price, which has obviously rallied on the back of the OPEC Plus agreement to increase production only marginally, as opposed to the bigger increase that had been planned. But the problem here is we're still at levels which actually don't meet budget requirements, and therefore the petrocurrency surplus that we have typically seen isn't likely to be there. And that is perhaps one area which we need to think about somewhat more carefully when we're thinking about trade dollars being recycled away from US dollars. Those are the thoughts for this week.